Years ago, trading options required paying massive upfront commissions. On the Australian Stock Exchange, for example, Heather Cullen remembers a single options trade carrying a $45 brokerage fee. Getting in and out meant paying $90 before making a cent. Today, the friction is gone. Modern brokerages offer zero-commission trading right from your phone, making the market seem more accessible and affordable than ever. But this chart visualizes the true cost of that free lunch. While the $0 commission baseline looks like a win for retail investors, the data shows retail options traders are actually bleeding between $5 and $10 billion every single year through the back door. 90% of all retail options traders end up losing money, and it is a steady drain. The average portfolio drops by 5 to 9% every month. By avoiding those old $5 or $10 entry fees, traders essentially invited brokers to extract a massive hidden tax straight out of every order. The house is charging you for the privilege of sitting at the table. Brokers are businesses, not charities. By removing commissions, they shifted their revenue model from the user to the transaction itself, monetizing the flow of order data before a single share actually changes hands. Through Payment for Order Flow, or PFOF, your broker doesn't send your order to a public exchange. They route it to a massive market maker. In exchange, that market maker pays your broker a kickback. Notice the payout difference. Brokers receive significantly higher kickbacks for routing options than standard stock trades, creating a massive incentive to push users towards options. The data reveals a direct correlation. The market makers paying the highest kickbacks to brokers consistently provide the worst execution prices for the retail trader. The zero-commission business model simply shifted the cost. It took a transparent, upfront fee and turned it into an expensive, hidden markup on the actual execution of your trade. The vast majority of retail orders never see a public exchange at all. 90% of all retail options traffic flows through a group known as the Big Three, massive wholesalers like Citadel Securities. Along with Susquehanna and Virtu Financial, these gatekeepers act as a tiny oligopoly controlling the final execution of retail trades. Through internalization, wholesalers pay to see retail data first, cherry-picking profitable trades to execute internally. Only toxic orders hit the public exchange. They extract profit through wide bid-ask spreads, taking their cut before the trade finalizes, forcing you to start at an immediate disadvantage. This creates a two-tiered, structurally rigged market. The retail investor is consistently forced to trade against a counterparty holding a massive data advantage. To keep that profitable order flow moving, brokers intentionally gamify their platforms. They deploy leaderboards, chat rooms, and constant push alerts to simulate psychological pressure, driving users toward higher trading volume. Seeing other traders post massive wins triggers performance envy. Retail investors try to emulate those returns by buying cheap, highly risky out-of-the-money options, treating them like lottery tickets. This animation illustrates why that strategy fails. Out-of-the-money weekly options suffer from time decay. The clock is always ticking against you. You need a massive, highly unlikely market swing just to overcome the broker's spread before the contract expires worthless. Professional traders often move toward in-the-money options, which provide high exposure to price movement by behaving more predictably like the underlying stock itself. One approach is a trip to the casino, paying a consistent gambler's tax to the wholesalers. The other relies on rules-based entries, treating options as a precise professional tool. The average retail options trader is being systematically harvested. Surviving this environment requires a departure from the high-risk, low-probability behavior that the system is designed to exploit.